Hey y'all, this is Sherelle Martin with Nitram Financial Solutions, where we teach bookkeeping without boundaries. So today I wanted to talk to you about how to accurately record transactions within an accounting software. So if you remember a while ago, I mentioned that, or a few videos ago, that uh, our training is software agnostic. That means that regardless of the software that you're using, you can follow these steps and tools that we give you. It doesn't matter which software you're using. So I wanted to give that caveat because I have people asking me specifically about certain platforms, and that's just not what we're catering to. So I wanted to give you some tips on how to accurately record transactions within an accounting software. And the very first one is that you need to gather receipts, invoices, bills, timesheets. Depending on what transaction you're trying to process, you need to have some sort of documentation that's called your source document. This is the document that dictates what you're doing and why you're doing it and how you're doing it. So, for example, if you're running payroll, then the source document would be timesheets from employees who are hourly. They need to submit their timesheets so that you can ensure that they get paid on time. If we're talking about vendor bills and vendor payments, then they need to submit a vendor invoice to the business so that they can be paid according to the terms and agreements of that business's payment policies. If you are processing expenses that aren't necessarily vendor bills, so the software subscriptions, the automatic debits that are coming out of a business bank account, there should be some sort of receipt that accompanies that transaction so that you know what was being paid for. If we're paying for expenses on credit cards, if we're paying for them on the debit cards, we need to have the receipt to validate what is being purchased. So make sure that you gather all the receipts as much as possible for every transaction. Now, asterisk, there's a little asterisk here. If you are performing a cleanup for a business for an entire year, an entire 12 months period or longer, you may not want all the receipts because it might be a bit much. And in that instance, you can record transactions directly as they've come through the bank statements. The bank statements will rule in that situation, and then gather receipts on the transactions that you are kind of questioning if they are actually valid or not, or if they are over a certain dollar amount, just to have additional support. So if that business becomes under audit, they have something to substantiate those purchases. So that's my little asterisk on that. The second thing you need to do is that you need to use the modules within the accounting software. So every accounting software is broken up into different modules depending on the service, depending on the type of transaction that's being recorded. So if you're recording checks and expenses, there should be an expense module. If you're recording customer payments or invoices, there should be a customer invoicing module. If you're recording payroll, there should be a payroll module. So depending on which module you're in, try to do the transactions within those specific modules and then match them up through their bank feed that comes in of choice. That would be the preferred method to do it. Now, there are going to be times where some transactions that need to be recorded don't fit into one of those modules, right? They don't fit into those buckets. An example would be trying to record depreciation for assets there's no depreciation module. Typically, you need to do those probably through a journal entry. Another instance is that we're going to talk about on another tip is recording expenses that the business owner actually paid for out of their personal funds. You can't record those through any other module because those bank accounts should not, I repeat, should not be connected to the books. And so you need to record those also through a journal entry. So there are very, very few instances where something needs to be recorded through a journal entry. And if you're unaware of how to do that, then seek your accountant, bookkeeper, or CPA to help you figure out how to do that. So that leads me to the third tip, which is to when there are expenses that the business owner is paying for out of their personal funds, their personal credit cards, then you need to record those as contributions into the business and to get the expense on the books. And those are actually done through journal entries. Do not, I repeat, do not connect the business owner's personal accounts. It is a mess. It can create a mess. So don't do it. Just don't do it. The third tip, or fourth tip, we're on four, right? The fourth tip is to make sure that you reconcile every month. So make sure that you're reconciling all of the accounts, all of the bank accounts. Any account that cash touches or goes through should be reconciled. That's checking accounts, saving accounts, payroll accounts, the cash apps, the Venmos, the PayPals, all of the credit cards. Every single account that is a cash account needs to be reconciled every single month to make sure that all the transactions are accounted for and accounted for correctly. Loan accounts, reconcile them every month as well. This is really important for a lot of different reasons. One, you want to make sure that everything that came through in the bank feed is actually in the books already and to be accounted for. You want to make sure that you're not missing any transactions, especially when clients do a lot of moving money around. So we're transferring from checking to savings, from savings to checking to pay the card, from this card we're taking an advance, like all the back and forths. You want to make sure that none of the transactions get missed and or miscoded incorrectly to something else. And so you want to make sure that you're reconciling all the accounts every month. You want to make sure you're reconciling the loan accounts every month so that you can ensure that the interest expense that they're allowed to deduct actually hits the P&L. And not just trying to reduce the loan balance that's on the liabilities of the balance sheet. So these are some things why you need to make sure that you reconcile every single month. And then the fifth tip is to actually review your work. So just because you are knowledgeable and you know what you're doing, we're human, right? We make mistakes. We might fat finger a number. We might accidentally transpose a number. We might think we clicked on one account when in actuality we clicked on another because the mouse is doing some crazy things. Anything can happen that can create mistakes. And so make sure that part of the reconciling process is also to help you catch your mistakes, but also review all of the other accounts as well to make sure that things are where they are supposed to be, right? So you're going to look at your balance sheet and make sure that all of the balances match the source documents that came in for that, because the source documents for those are different from the source documents to record the transactions. What do I mean by that? So for a bank reconciliation, the source document is the bank statement. So we're validating that the balance on the books matches the balance on the bank statement. And if they don't, what's that reconciling difference? The same with credit cards, the same with loans. With fixed assets, we want to make sure that we're recording that we know that the balance that's in that account equals the total assets that the business has on hand, right? You're looking at your P&L and reviewing expenses like repairs and maintenance and office expenses and making sure that things that should be capitalized are not coded in those accounts. You're looking at your payroll account and reconciling that to the payroll returns every quarter to make sure that the payroll transactions are recorded properly in the books as well. So there's a slew of different things that we'll go over in more detail when we do our financial analysis video, but I wanted to kind of give you a heads up on what those are. So making sure that you review your transactions, review your work, review the financials every single month also to ensure that the transactions are where they are supposed to be. So those are your 5 tips that I'm giving you on how to accurately record accounting transactions. You want to gather all the receipts. Number 1. Gather all your source documents and receipts. You want to use the modules within your accounting software. Don't just try to put everything in one way or the other. Don't just try to post them off from the feed without proper recording from the actual modules. You want to make sure that you are putting in the expenses that the business owner pays for out of their personal funds because they want those deductions. Make sure you're putting those expenses in as one of the very, 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 very few transactions that go in as journal entries. Because I don't condone or I don't recommend using journal entries unless you absolutely have to. And then the 4th one is to reconcile every single month to make sure that no transactions got missed. And the 5th one is to review your work to make sure that you didn't mistakenly put something where it wasn't supposed to be. So those are your 5 tips on how to record transactions accurately. And I will see you guys next week. Oh, wait, first, I forgot to say, if you like this video, please feel free to subscribe, share it with your friends and followers so that we can help more people do bookkeeping without boundaries. See you next week.